Hello and welcome back. In today's video, we are going to take a look at two ETFs which have been very popular recently, XDTE and QDTE. Both these ETFs are quite new, around only 7 months old, and they are listed on the US stock market. However, what makes them very special is the fact that both of them are very high yielding ETFs and have been outperforming the underlying indexes on which they are based. So in case of XDTE, it is outperforming the S&P 500 index, and in case of QDTE, it is outperforming the Nasdaq index. This is very encouraging. The fact that a covered call ETF is able to outperform its underlying index. It is still too early to say whether this trend will continue in the foreseeable future, but nonetheless, it is worth taking a look at these two ETFs and see how they are able to secure such impressive total returns. So in this video, we will be taking a look at these two ETFs, how they work, and also I will comment on whether this is a good investment from a Canadian perspective. Because as Canadians, we end up paying a withholding tax for any income that we get from a US listed stock or ETF, and that may affect the total return we might receive from this investment. So without further delay, let us get started with the review. Let us first take a look at the covered call strategy used by these ETFs, starting with XDTE. In the title, it mentions that it is using 0 DTE covered call strategy. 0 DTE stands for 0 days to expiry. These are options that expire on the same day as they are traded. These type of short-term options existed in the past as early as 2005, but it was only in 2022 that it became possible to trade them on all 5 working days. Previously, there was a limit for trading these options on certain specific days of the week. Even now, it is not possible to use this option on single stocks such as Tesla or Nvidia. They can only be used on indexes such as S&P 500 and Nasdaq. So that is the first part of the strategy. The primary benefit of using these 0 days to expiry options is that the option has a higher probability of ending worthless as opposed to a monthly option. This benefits the fund because they are the ones selling those options. Thus, they are able to keep majority of the premium income from the option sale. The second part of the strategy we find in the short description given over here, where they mention that they are using a synthetic covered call strategy. A synthetic strategy is one where instead of directly holding the underlying company or index, the fund buys long term options that mimic the price movement of the underlying stock or index. If we look at the holdings of XDTE, we find that these are all long term options expiring in 2025. These long-term options are meant to replicate the price of the S&P 500 index. This is similar to how yield max funds like Tesla operate. They synthetically mimic the price of Tesla shares using a combination of call and put options. The main benefit of the synthetic strategy is that it greatly lowers the capital requirement for the underlying holdings when compared to directly holding the company shares or the index. For example, if you need $100 to hold 100 shares of a company, using the synthetic strategy, you can hold the same 100 shares for only $50. Or you can use the $100 and hold 200 shares worth of stock through the synthetic strategy. In the first case, where you're holding the stock directly, you can only write one covered call option. But in the second case, where you're holding the stock synthetically, you can now write two covered call options. Thus, using the synthetic strategy provides a leveraged effect without the need for actually using any leverage. Everything I have said so far about XDTE is also true for QDTE. It uses the exact same strategy of 0 days to expiry options combined with synthetic holdings. In short, Roundhill is combining the best strategies from Defiance and YieldMax and using them in these two ETFs. But the funny thing is that neither Defiance nor YieldMax have ETFs that outperform their underlying holdings. So, is Roundhill doing something different, something extra, that is helping their ETFs outperform the underlying indexes? The answer to that question is yes. There is an extra layer of strategy which relates to how they time their 0 days to expiry options. If you take a look at the fact sheet document on the web page of either the QDTE or the XDTE ETF, you will find this diagram which gives you a visual representation of what they are doing. The diagram on the left shows you the covered call position during the trading hours, which is from morning 9 till evening 5. So they write the 0 day to expiry option at the start of the day and close it at the end of the trading day. During this time, the upside potential for the holdings is limited to the strike price at which the option was written. But the diagram on the right shows you what happens to the holdings overnight. Since the option is closed at the end of the trading hours, overnight there is no limit or cap on its upside potential. Hence, it can gain 100% of the upside in the after hours trading period, as well as in the pre market trading period the following day. This is very important. In the US stock market, after hours and pre market trading is quite normal, and the stocks of individual companies as well as indexes can gain incredible upside during these hours. This effect is known as gap up, as demonstrated in this chart, where a company or an index starts trading at a significantly higher price compared to where it closed the previous trading day. Of course, this can work the other way as well, where the stock or index starts trading at a lower price compared to where it previously closed. But either way, Roundhill is making sure that they get the benefit of the gap pricing for the holdings of both these ETFs. What makes this approach even more interesting is that the biggest moves in the market often happen in the pre market or after hours trading period. For example, recently Tesla stock went up by 11% in the after hours trading period after reporting better than expected earnings. This screenshot shows the after hours gains at the close of the trading period on October 23rd. The following day, on October 24th, Tesla gained a total of 21% as shown in this screenshot. The point being that more than half of Tesla's gains on October 24th actually happened in the after hours trading period on October 23rd. This is also true for indexes, where if the market is bullish, then a good chunk of the index's gains will come from after hours or pre market trading period. Another way to think of this is that approximately 50% of the time there is a cap or limit on the underlying holdings due to the covered calls being written on them. But once the covered call is closed, the remaining 50% of the time, which is mainly the pre market and after hours trading period, there is no limit and the holdings can grow along with the market. This ensures that the NAV or net asset value of the fund gets the opportunity to recover during bullish periods in the market. I think this is the main reason why we haven't seen a significant decline in either XDTE or QDTE in terms of their NAV, because both of them are able to recover during bullish periods. So now you understand why XDTE and QDTE are able to not only generate higher income but also provide a total return that either matches or exceeds the underlying holdings. It is a great combination of using 0 days to expiry options combined with synthetic holdings and also timing the option writing in such a way that it is possible to capture the growth during the after hours and pre market trading periods. If you look at yield max ETFs, they are using synthetic holdings, but they are not able to write 0 days to expiry options since their ETFs hold single companies instead of indexes such as S&P 500 or Nasdaq. Similarly, Defiance has a different set of limitations. Although they are able to write 0 days to expiry options, they are selling put options instead of writing covered calls. This means that their holdings mainly consist of cash and treasuries, which are used as collateral against the put options they are selling. In other words, there is very little scope for growth during the pre market or after hours trading period because they are not actually holding the index either directly or synthetically. With all this highlighted, it is important to ask, is this a good investment for people in Canada, especially when it comes to tax implications? In the US, for sure, both these ETFs are a great investment because you could hold them in a tax sheltered account and thus receive the income while also capturing a great overall total return. But in Canada, even if you were to hold them in a tax sheltered account such as TFSA, you will end up paying a 15% withholding tax. You could avoid the withholding tax by holding them in an RRSP, but when you decide to withdraw it, you will still end up paying provincial and federal taxes, which could be as high as 20% depending on your province. And it goes without saying that the worst case scenario would be holding these ETFs in a cash or regular account. In that case, you would end up paying both the withholding tax as well as federal and provincial taxes. So, in short, if you're in Canada, in general, it is better to go with Canadian based ETFs such as HYLD and USCL, which focus on US stock market. But because they are based in Canada, we do not pay any withholding tax. Often their payouts are also structured in such a way that you could minimize federal and provincial taxes in a cash or regular account. Of course, there are certain specific situations where you could make XDTE and QDTE work even in Canada. For example, you can invest a lump sum amount in these two ETFs in an RRSP account, and instead of withdrawing it, simply invest the income to buy other stocks and ETFs. But that is a very specific scenario and may not be applicable to everyone. And that is my review of these two ETFs. Let me know in the comments if you hold these ETFs or are planning to buy them. As always, thanks for watching, and I will see you guys in the next one.